What's up, YouTube, and welcome to another episode of Finance and Freedom. My name is Todd, and today we're going to talk about ULTY's Nav Erosion and its dreaded and impending reverse split, and why it doesn't really matter. Let's get into it. As I'm sure all of you already know, it's been a really rough month for the stock market and cryptocurrencies. The government shutdown has taken a toll, as well as the potential trade war with China. The market is really uncertain, and it can be seen from the volatility of the market. Everything's just been up and down all month. The fear and greed index is showing that everyone is in fear. If you've watched any of my other videos, you probably already know that I think these are the best times to be buying. As Warren Buffett famously says, be fearful when others are greedy, and be greedy when others are fearful. It sounds like these that it's important to test your intestinal fortitude and stay strong when others are selling off their assets in fear. Fortune favors the bold. Now, let's talk about ULTY specifically. Nav Erosion has always been a hot topic when it comes to ULTY and other YieldMax ETFs. And while I don't really think this principle applies to other YieldMax ETFs, I don't think Nav Erosion really matters when it comes to ULTY. And here's why. Let's take a look at an investment calculator and see the potential future of what ULTY looks like. All right, so I pulled up a website that I really like using called dripcalc.com, and I'll try to remember to put it in the notes down below. But all you have to do is enter in the stock ticker. Now, the problem with most stock investment calculators is that you have to input all your own numbers and you have to do a lot of digging, figure out what it is. Well, this one you enter in the stock ticker and it pulls up all that information for you. So we're going to enter in ULTY. Load. Okay, now you can see automatically it pulls up that the dividend growth rate is at negative 25%, which sounds about right, and the share price growth is at negative 55.34%. Also sounds about right, which if you're a normal investor, you're like, oh man, that's terrible. However, let's see what happens when you actually punch in some additional numbers. So we're going to start off with an initial investment of $10,000, and we're going to set the extra investment to 0. We're going to look at it for over the course of 5 years, and we're going to hit calculate. Now, if you scroll down, you can see a majority of the income or the growth comes in year 5, and look at that. But if you scroll down, it actually breaks down each year individually. So in the first year, and the balance puts you at $19,594. Second year puts you at $55,741. By the end of the 5th year, you're sitting at nearly $43 million. Now, as much as I like this website, dripcalc.com, it seems to be a bit optimistic to me. As much as I would love for these numbers to be true, and maybe they are, but like I said, it doesn't really seem to be reflecting what my own investments are showing. And so I decided to create my own Excel spreadsheet that actually, I think, does a better job of keeping things a bit more realistic. Let's take a look at that. All right, so I created this and called it Real ULTY Numbers. And you can see in the top here, we start with a balance of $10,000. Now, I wanted to break this down week by week. I mean, I wanted to go, really detailed with this whole thing. And so for the first start, when we start off with $10,000, you can see each week the share price is going down. And so right now, we're coming down to the bottom of the first year. You're looking at a balance of $15,450. That is a 54% increase from your original $10,000. So you made a grand total of $5,450.95 in the first year. Now, that's a pretty amazing investment, especially considering the fact that this is saying that the share price is going to go down to $3.45. That's pretty amazing. And to top it all off, I actually don't think it's going to drop that low. I think these numbers could indeed be pessimistic, and maybe it's somewhere between the two. So let's take a look at year 2. Obviously, we're starting off with a balance of $15,063, just like we ended. But we're going to scroll down, and once again, you can see the share price comes down to $2.10, and you can see that the dividend amount is also going down. So now it's only kicking off right around 3 cents per share. But even with all those numbers continually degrading and going down, we're sitting at $22,681 after year 2. Now, I don't know about you guys, but I think that's a pretty amazing investment. This year alone made $7,618. Now, I could bore you with going year by year, but I think you guys are getting the idea. We're going to go ahead and skip to year 5. Scroll back up to the top. So the starting balance on year 5 would be $51,485. I'm going to scroll down, and you can see right now the share price goes down to 47 cents per share. Now, obviously, we're going to have at least one reverse split between now and then, maybe several. And I don't think that really matters, and I'll get to that here in a little bit. But if you look down below, the total amount that you've earned would be $77,313, even though the value of the stock went down to 47 cents, and you're only making 1 cent per share. So that means that year, year 5 alone, you made $25,827. Now, that 1 year alone, you made 2.5 times your original investment. That's pretty amazing. And this snowball effect is just going to continue to get bigger and bigger and bigger. As you can see, year 2, you were making $7,000, and on year 5, you're making $25,000. It's going to be pretty amazing. So as you can see, time is what's going to be the most valuable asset whenever it comes to ULTY, because it's really going to let things compound interest. All right, after looking at the numbers, it's clear that Nav Erosion shouldn't be the key factor when investing in ULTY. In fact, ULTY was at a value of $5.45 back in April of this year. That means that the Nav Erosion has only been about 6% since then, or 6% down, all while kicking off about 2% per week in dividends. All right, let's change course a little bit. In case you weren't familiar with it, there's a general rule in investment that a lot of people follow called the rule of 7. So if you've invested well in the stock market in something safe, an ETF like VU or SPY that tracks the S&P 500, you can expect to double your money every 7 years. It's actually 7.2, but they kind of omit that. If you take a look at the charts that we just looked at, ULTY stands to make way more than that. So even if the value of the ETF continually just keeps on dropping, it will continue to snowball and outperform the S&P 500. The main reason is, like I said, due to that snowball effect. The biggest problem with the snowball effect is that it actually takes time for it to start doing its thing. And so I'm sure a lot of you who are just getting into it, maybe you are even down right now. You got to give it time to snowball and build up those dividends and make it even better. As you can see from the charts, most of those gains come from the last year investments. This is why it's important to keep your money invested and keep on working for you. All right, let's talk about the elephant in the room, the impending reverse split. It's really not a question of if, but more a question of when. For those of you who don't know, a reverse split is when the value of the stock or ETF, it goes low enough that they cut the number of shares that each person has, but makes the value of the stock commensurate to the number of shares that they took away. So, for example, if you had 100 shares of a stock that were worth $1 a piece, and let's say they do a 4-to-1 reverse split. That means, you'd take your 100 shares and you would divide that by 4, which means now that you would have 25 shares of that company. But they would also take the value of that share that was at $1 and multiply it by 4, meaning you would now have 25 shares of the company that is worth $4 per share. So, in case you're not tracking, in either situation, you would have $100 in that company. You didn't lose any value when the reverse split occurred. However, investors can get spooked by a reverse split and feel like the future of the stock or the ETF is in trouble. So this can trigger a sell-off and make the value of the company go down. If that's the case, then why would they do a reverse split? Well, both the NASDAQ and the New York Stock Exchange have rules that say that an ETF's price must not close below $1 for 30 consecutive business days. And if it does, it's possible that the ETF or stock will be delisted. All right, so there's several key points in time in which an ETF or a stock would consider doing a reverse split. The first level is at $5, which we're actually getting really close to at the moment. I think it was at $5.08 today. So many retirement funds and investment plans won't hold securities or stocks that are under $5. So this means that going below this price would actually cost the ETF a lot of potential investors. Another key price point is at the $3 mark. Most investment companies require 100% margin maintenance on any stock or ETF that is at or below the $3 mark. Now, a common investment strategy that a lot of you ULTY owners use is to use margin to buy a bunch of the shares and just let the weekly dividends pay off the margin. It's actually a really great strategy. Now, once the margin is paid off, they do the same thing and just build up their portfolio over time. The problem is that if the maintenance goes up to 100%, these types of investors won't be able to invest nearly as much. And so that's going to also result in a degradation of the price, have a price decline over time. Now, YieldMax is very aware of this, and I'm fairly confident they'll do a reverse split before we actually get to this point. So the last price point is like we talked about earlier at the $1 mark. The ETF could be removed from the New York Stock Exchange or NASDAQ if we get to that point. All right, so to sum it all up, I really think ULTY is a great investment regardless of whether Nav Erosion or reverse splits are actually a thing. If you take a look at the charts, it has a potential to be a really solid investment, even if you're using my pessimistic chart. If you use the other chart, I mean, the gains could be astronomical. So like I said, I think my chart is probably a bit more reasonable, but I'm open to the possibility that it could be explosive, as can be seen on dripcalc.com. Anyway, I hope you enjoyed this video. Feel free to hit the like and subscribe button if you got anything from this video. It really helps out the channel. I'll see you again in the next one. Thanks.